Okay. Okay, so good evening to all the students present in this today's session. Today's session, we would be discussing on dividend decision, chapter called dividend decisions. Before we start with this chapter, dividend decision, I would like to ask you all, what are the three basic management decisions that every company's CFO or financial manager has to take? Batao. Which are the primary three decisions that all the financial managers or CFO of any company has to take? Investment, dividend, and financing. Pranav is right. The three decisions that any financial manager of the company, or I would say any CFO of the company, has to take: investment decision, financing decision, and dividend decisions. Correct? Investment decision and financing decision are already covered. As far as investment decision is already covered, financing decision maybe it would get covered, or I don't know whether it is already covered or not. But today we would be just focusing on this dividend decision concept. Okay? What is this? Hardik, today's session is on investment decision. If you have any, on dividend decision. If you have any queries regarding investment decision, you can attend revisionary live lectures, or whenever institute conducts doubt solving session, you can ask at that point in time. Today it would be only on dividend decision. So please cooperate. Okay? Now, investment decision. What was the ultimate objective of investment decision? It answers two questions: where the company should invest, where the company should invest, and how much to invest, and how much to invest. This was done under investment decision. Where the company should make investment, under which project company should invest their funds, and how much funds should be invested in that project. So this was covered under investment decision. Now, once the amount of investment is determined, next step is to arrange the funds for investment, is to raise the funds for those investment. And that answer was covered, or that question I would say was covered in financing decision. From which sources company should raise funds for investment? So can I say the chapter here, it was capital structure, from which different sources company should raise funds, and each different sources had its respective cost called cost of capital. Okay? So these two decisions are already done and covered. Whether to accept the project or not. Yes, Vibor is correct. Investment decision is whether to accept the project or not. And once the project is accepted, then we have to decide how much to invest in that project. So again, that is also part of investment decision. And once how much to invest is determined, next step would be to arrange the funds for that investment. And that all task was covered under financing decision today. And the last decision is dividend decision. What do you mean by dividend, students? Very simple. See, just for your general knowledge, dividend is coined from two words: divide and end. It is coined from two words. Which are those two words? Divide and end. Divide what? Divide profits at the year end. At the year end. This is how dividend word has been coined. Divide the profits at the year end. That is called dividend. Understood? Dividend is nothing but distribution of surplus. In simple layman terms, it is nothing but sorry. is nothing but distribution of surplus or profits earned by the business. Okay. Now, what is the objective of this chapter? What is the ultimate objective of dividend decision chapter? What is the ultimate objective? The ultimate objective is to decide what to decide, whether to distribute dividend or not, whether company should distribute dividend or not, and if yes, if the answer is yes, then what should be the optimum dividend payout ratio? This is the ultimate objective of this chapter, or ultimate objective of dividend decision chapter. Yes, correct. And Nisriwani, yes, correct. Ultimate objective is whether the company should distribute the dividends or not. And if yes, focus on this word. What should be the optimum payout ratio? Can I say in other words, optimum payout ratio should be that ratio. Please hear carefully. Yeah? Optimum payout ratio should be that payout ratio that maximizes the wealth of the shareholder. Yes or no? See, what is the ultimate of objective of any three decisions? Ultimate objective is this only, to maximize the wealth of the equity shareholders, to maximize the share of ultimate owners. So we have to select the optimum payout ratio in such a way that it maximizes, it creates maximum wealth to the shareholders. So does 0% of dividend create maximum wealth, or 10% of dividend will create maximum wealth, or 25% of dividend distribution will create maximum wealth? Similarly, 60% of dividend distribution will create maximum wealth, or 100% of dividend distribution will create maximum wealth. This we need to decide in this chapter. This we need to learn in this chapter. Whether the optimum payout ratio should be 0 or 10 or 25, 60, 100, kitna hona chahiye. That decision making we have to learn in this chapter. Are you understanding the broad objective, the perspective of this chapter, students? Any doubts still here? Any doubts? Any queries still here? Okay, so let's move ahead. Now let me ask you, what is your opinion as a layman or as a finance student? Let's say there are two companies, company X and company Y. Company X is paying regular dividends, is paying regular dividends since its inception, whereas company Y hardly pays any dividend. Hardly pays any dividend. So bolo, in which company you will invest? What is your opinion? Just think from layman perspective. Don't deep dive into any complex thoughts. Just think from layman perspective. There is one company which regularly gives dividend, which regularly distributes dividend, and one company, it retains everything with itself and hardly pays dividend. Which company should investor invest? Company X. Yes, everyone is saying company X. Why? Because it is paying regular dividends. So can I say in other words, the share price of company X, as far as just dividend perspective is concerned, it will rise because demand will increase. Correct? So can I say ultimately, dividend decision of the company affects the market price of the company? Are you understanding the analogy? Every one of you are of the opinion that investor would invest in company X. Logically correct. As far as just dividend perspective is taken, people will invest in company X. So in other words, companies X ka share ka demand will increase. It means directly or indirectly, dividend does affect market price of the shares. Yes or no? Yes or no? So yes, according to you, yes. According to me, also yes. So just like you all had opinion that dividend decisions of the company affects market price. MP means market price of the share or market price of the company. Just like you all have the opinion of yes, there are two finance scholars that had similar opinion. Who are those finance scholars? Walter, and it is called as Walter's model of dividend decision. Second is Myron Gordon. These two are of the same opinion that company's dividend decision does affect the market price. Means it has relevance in the market price. And that's why this is called as relevance theories. Relevance theories of dividend decision means dividend decision has relevance in the market price of the company or dividend decision does affect the market price of the company. Means according to this scholar, according to these two finance scholars, if dividend payout ratio is 10%, then market price would be something else. If company changes its dividend decision from 10% to 60%, then market price will also change. This is what these scholars are saying. That's why as of now, I just said, think from just dividend perspective. If you have listened carefully, then I just asked you just from the dividend perspective. Okay? So right now, we are just thinking from dividend perspective, ignoring other monetary, non-monetary factors. Okay? So according to these two finance scholars, Mr. Walter and Mr. Myron Gordon, they are of the same opinion like you all, that dividend decision of the company will definitely have an impact on market price. That is why it is under relevance theory. Whereas there is one finance scholar called Maud Gilani Miller. This you have learned under capital structure theory as well. Under capital structure theory as well, MM was under irrelevance side only. According to MM, capital structure can be anything. It does not have any relevance to cost of capital or market value of the company. Similarly, here also, MM is always on the negative side in financial management. Here also, according to MM, he says that dividend decision of the company can be anything, be it 10%, 60%, 50%, 0%, 100%. It will not have any impact on market price of the company. It will not have any impact on the wealth of the shareholders. It will not have any impact on the market value of the company. Are you getting this? Are you getting the flow of the chapter? So my MM says that dividend decisions are irrelevant for market value or for determining the market price of the company. So as far as this chapter is concerned, we have to learn theories given by Walter. We have to learn theory given by Gordon. We have to learn the theory that is given by MM. Apart from these three theories, apart from these three models, we have to also learn some other theories given by other finance scholars. The name of that scholar is Graham and Dodd, Lintner's model, and residual approach. Apart from these three theories, Walters, Gordon, and MM, we have to also learn some other theories given by other finance scholars. It is there. It is there. You have theories in your module. Graham and Dodd, Lintner, and residual. Can you see Graham and Dodd? Can you see the formula? Can you see Graham and Dodd? And then can you see Lintner? Can you see Lintner model? Can you see Lintner's model? So it is there. Don't worry. So we have to learn this. Now, see friends, financial management is all about formats and formulas. Under different chapters, you have learned different formats of income statement and you have learned different formulas. So under this chapter also, it is all formula based chapter. All the finance scholars, all the scholars have given their respective formula for calculating the market price of the company. Walter has given its own formula. Gordon has given its own formula to calculate market price. has also given his own formula to calculate market price. Graham and Dodd has also given its own formula to calculate market price. Lintner has given formula to calculate dividend to be distributed in the current year. Lintner and residual approaches are more on practical aspects. We are of the opinion like what should be the current year's dividend that company should declare. They are not of the opinion whether dividend decision is relevant to market price or not. No, their analysis is not about that. Unlike these three models, unlike Walter, Gordon, Lintner is of the opinion that what should be the expected dividend in the current year. Whether it will have effect on market price or not, I am not concerned with that. So these are more practical aspects. Understood? Are you understanding the broad insights of this chapter, what we have to learn? So as I said, this chapter is entirely formula based. You have to just remember the formulas and apply in the question. Once you have remembered the formula, then this chapter is very butter for you. It's very smooth for you. Okay? However, we will try to understand the derivation of the formula as well. As far as examination is concerned, you don't have to give so much weightage to the derivation, but just for your easy remembrance, I will try to derive the formula that each one of them has created. Okay? To the extent possible. Understood? So let's begin with Walter formula. Or let's begin with Walter's approach. Walter's model of dividend decision. First of all, in the back of the mind, you have to remember, you have to keep this in mind that Walter is under the relevance side. So according to Walter, dividend decision of the company or dividend payout ratio of the company will definitely affect the market price of the company. So if dividend declare is 10%, market price would be X. If dividend declare, let's say if dividend declare is 50%, then market price would change. So it has relevance. Dividend decision has relevance in the market price. Okay? So let's start with Walter's model. First of all, let me write down the formula. And this formula you have to remember. Formula of the price today. Formula of the market price today. As per Walter. See, market price today is denoted by P0. Okay? This you have learned in cost of capital chapter. Price at today's point, at 0 point, is denoted by P0. Is nothing but D plus E minus D multiply by ROI upon KE, the whole upon KE. KE is nothing but cost of equity. P0 is market price per share today. D is nothing but dividend per share. Dividend per share. E is nothing but earnings per share. ROI is return on investment. KE is cost of equity or capitalization rate. Cost of equity means cost of equity to the company. In other words, it is nothing but expectation of the shareholders. See, Shareholders will provide fund to the company. Equity shareholders will provide fund to the company. So in this providing the funds, they would expect something in return. Yes or no? They would expect some return from this capital that they have provided. For them, it is income. For the investor, it is income. But for company, it is cost. That is called cost of equity. Are you getting this? KE is nothing but expectation of equity shareholders. And this you have also learned in cost of capital chapter. And under cost of capital chapter, you know, KE can be calculated by 6 different ways, by 6 different methods. Okay? The formula given by Walter is nothing but D plus E minus D multiply by ROI divide by KE the whole upon KE. Now looking at this formula, it's very confusing. But let me try to derive. You don't have to remember the derivation. You just have to remember the formula as far as examination is concerned. But for the first and the last time, let's try to derive the formula. Okay? See, under cost of capital chapter, there are 6 different ways to calculate K. And one way or one formula or one method of K was, the formula was earnings upon price of the share today. This was the formula. Hope you all remember. Do you remember this? If not, then you have to revise cost of capital chapter. Let's say as an investor, I'm investing at a price of 20 today and the company is able to generate earnings of 5. So can I say 5 upon 20 is the return to the equity shareholder? Return to the equity shareholder means cost to the company. Okay? So I hope you are recollecting this formula. E upon P0. Okay? So can I say P0 is nothing but E upon KE? Correct? उल्टा सुल्टा इधर उधर कर दिया. P0 I took it upwards and KE downwards. ठीक है? अच्छा, now tell me, if I write this way, E plus D minus D upon K, will my answer change? Plus D minus D will get knocked off. Still, the answer, the ultimate answer remains E upon K. Yes or no? Just try to carefully understand the derivation. Again, I am repeating, you don't have to focus on derivation. You just have to remember the formula. But just for first and last time, I am showing you the derivation. Okay? So the answer will not change. Okay. So if I write this way, D plus E minus D upon K. Again, the answer will not change. बस D को आगे ले लिया. I took it front side. Again, the answer will not change. Okay, next step. If I write this way now, I'm just splitting the denominator. Again, the answer will not change. Yes or no? I just splitted the denominator. Are you getting this? Till now, clear? Till now, clear? Everyone? Now see, friends, this E minus D, can I say earnings minus dividend is nothing but retained earnings, reserves with the company? Yes or no? Earnings may say if I deduct the dividends from earnings, if I pay the dividend, can I say the portion, the balance portion would be the retained earnings of the company? So in other words, this E minus D is nothing but reserves that the company has. And this E minus D, what Walter did, he multiplied it by ROI divided by K. Are you getting this? He just multiplied E minus D with two variables, ROI divided by K. Now this entire portion of E minus D multiplied by ROI divided by K represents the productivity of reserves and surplus. Represents what? The productivity or efficiency of reserves and surplus. Efficiency of reserves and surplus or retained earnings. How? Let's discuss that. How? how it determines the efficiency, let's discuss that. So let's say, see, unless otherwise specified, there is one general assumption of this chapter that all the capital is through equity, unless otherwise specified. And this assumption is also practically used. Let's say you want to start a business and you have invested a capital of 10 lakh. So if someone asks you like how much is the capital that you have invested, you would say 10 lakh. So by default that opposite person will assume that आपने खुद का पैसा लगाया, आपने लोन लिया नहीं लिया होगा. This is the general assumption, standard assumption of industry, that unless otherwise specified, own funds are invested in the business. ठीक है? So let's say funds capital is raised by a company and this is raised through equity shareholders. They have provided funds to the company. Will the company keep these funds idle? Will the company invest in Dream 11? Absolutely not. It will invest in business. And from that investment, can I say company will earn some return called ROI, return on investment. Understood? Company, see, visualize, a company raised the funds from equity shareholders. It invested in the business. From that business, company generated return on investment, some return from that investment. And from that return, can I say company will pay return to the equity holders what they are expecting, and their expectation is KE to the company, is cost to the company. Are you following this? Any doubts still here? Company raised capital from equity holders. It invested in business. From that invested, company earned some return called return on investment. And from that return, company will pay out the expectation of equity shareholders. Their expectations cost to the company. Are you getting this? Till now, any queries? ROI is the actual rate of return, not the required rate. It is the actual rate of return earned from the investment. And K is the expected rate of return by the equity shareholders, by the investors, by the capital providers. So their expectation becomes cost to the company. Okay? So let's say, now think, had these reserves been distributed to the shareholders, if the company had not kept these reserves with itself, had the reserves been distributed to equity shareholders, can I say they would have earned KE on that reserves? Yes or no? Can I say they would have earned KE on that reserves? If the company had not retained this with itself, please listen carefully. If the company had not retained these funds with itself, it would have distributed as dividend. And the dividend, from that dividend, equity owners will earn KE by investing in somewhere else. Yes or no? Are you getting this? But since the funds are with company, company has the capacity to earn ROI. Let's say reserves is of rupees 100. Let's say reserves is of rupees 100. KE, expectation of shareholders is 10%. ROI, if the company had invested, the ROI from the investment is 20% of, or sorry, 30% of the company. So can I say, if this 100 was distributed as dividend to the shareholders, they would have earned 10% from somewhere else. Had the funds kept with the company has the capacity to earn 30%. Means in other words, can I say company has the capacity to do, company has the capacity to do 300 of this 100? Yes or no? कंपनी अपने पास फंड्स रखती है तो 3 गुना कर सकती है. आर यू गेटिंग दिस? Had the reserves be with company has the capacity to do 3 times of this 100. Company has the productivity of to make 3 times of this 100. एक का 3 कर सकती है कंपनी. So can I say this represents the productivity, the efficiency of reserves and surplus of retained earnings by the company? That is the numerator here. Can you see? This is how formula is derived. That is the numerator over here. Understood? E minus D multiplied by ROI divided by KE represents the productivity or the efficiency of the company to do with the reserves. एक का तीन कर सकती है कंपनी अगर अपने पास रखती है तो. Yes, it depends on the dividend policy of the company. So that's what we are discussing right now. So did you understand the formula, how it is derived? You have to just remember this part. But the derivation I have showed you. It is nothing but E upon KE plus the efficiency of reserves or productivity of reserves plus the efficiency of the company to do or to generate multiple times of ROI. No, Pallavi, you are wrong. Your inference is completely opposite. If ROI is greater than, now listen very carefully, yeah, students. Since Pallavi has raised this question and I was about to come this point, if ROI is greater than KE, can I say company has more earning capacity or more efficiency than the equity shareholders? If I would have distributed the dividend to them, they could just earn 10%. But if the company retains with itself, company has the capacity to do or to earn 30%. एक का तीन कर सकती है. So can I say it is better to retain with the company? It is better to keep the funds with the company so that it grows in multiple times. Understood? So the inference of Walter is this only. If ROI is greater than KE, don't distribute dividend. Don't distribute dividend and keep with itself and retain everything. This is what Walter in his conclusion has said. If ROI is greater than KE, it means that company has more efficiency, more earning capacity. Company has the capacity to do ek ka teen in our example. So it is better to keep the funds with the company and let it do ek ka teen. Understood? Okay, no worries. Okay. So this is the first inference. If ROI is greater than KE, don't distribute dividend and retain everything. In other words, optimum payout ratio of dividend is 0%. Optimum payout ratio of dividend is 0%. Are you getting this? If ROI is less than KE, if ROI is less than KE, it means, so in our example, let's take this as 9% or 8%, sorry. If ROI is less than KE, it means it is beneficial to distribute dividend entirely. Because if the company would distribute dividend entirely, investor will earn 10%. Investor will earn 10% from other investments. But if company keeps it with itself, it will earn only 8%. So ideally, to maximize the wealth of the shareholder, ideally company should distribute everything because equity shareholders has more earning capacity than the company. So let them take that benefit. Understood? Students, distribute everything. Distribute everything and retain nothing. This is what Walter has given in his conclusion statement. So in that case, optimum payout ratio. In that case, optimum payout ratio should be 100%. If you distribute 100% of profits, they are in the better position to earn more. So their wealth will be maximized in that case. Hope everyone is following. And when ROI is equal to KE, you are free to do anything. Whether you want to keep, whether you want to distribute, It is up to you. It will have no effect on the wealth of the shareholders. In turn, it will have no effect on the market price. Understood? Walter's model, everyone. Can you just go through the formula? Can you just go through the formula and quickly capture this in your mind? And if I ask you the formula, can you type in the chat box? After that, can you just quickly memorize this formula? Not to memorize, I have shown you the derivation. So आपको रट्टा नहीं मारना है. The derivation is also there of this formula. But did you understand the price? So as per Walter, the price of the share today is dependent on dividends plus the efficiency or the productivity of reserves and surplus. The price of the share today is dependent on two variables, the future dividends plus the productivity of reserves, the earning efficiency of the reserves. Okay? Now please write down the formula in the chat box. Let me check whether you all have remembered the formula or not. Please write the formula on the chat box. Yes, correct. Sukhvir is correct. That is the whole upon K. Yeah, you are correct. Correct, correct. The whole upon K. Yes. Nice, nice, nice. Everyone has remembered the formula now. Yes, correct. So this is the technique to remember the formula. Just focus on the derivation, just and try to memorize the formula. Don't rectify. Okay? Now Walter's model, see, under capital structure theory also have explained that whenever any finance scholar gives some theory or places some theory, it is always backed by certain assumptions. They are always backed by certain assumptions. Without the backing of assumptions, no theory in this globe can be made. So the assumptions, yes, Sheikh, you are also correct. Rachna, thank you guys. Thank you. You all are correct. And you are paying attention very carefully. So it is nice to get such response. There are certain assumptions of this model as well. Any theory anyone brings in financial management, it always has to be backed by assumptions, because without assumptions, the theory cannot be made. So the general assumptions of this theory, the important assumptions of this theory are in the formula itself. D remains constant. Means dividend per year of the company will remain constant. Are you getting this? Dividend of the company will remain constant. Second is ROI will remain constant. And third is KE will remain constant. All the variables used in the formula would be constant. Yes, yes, yes. Everyone is correct. These are the general key assumptions. Key assumptions. Fourth, as I said, unless otherwise specified, entire capital would be from equity. Entire capital would be from equity. That is, there would not be any debt in the company. Fifth, but not the least, the going concern assumption that we use in accounting, life of the firm would be infinite. जब तक है जान, तब तक कंपनी चलती रहेगी. जब तक है जान, ठीक है? Life of the company would be infinite. This is also a going assumption in accounting as well. We assume once the company is formed, it will go on and on and on and on and on till lifetime. ठीक है? Perpetual succession. That is called perpetual succession assumption. So to get better clarity on Walter's model, let's take some illustration. This is third. Whatever concepts I explain, I give better clarity by taking some numbers, by taking some figures, so that everything gets clear. Okay? let's see in the module if we have. Okay. Okay. This is the illustration. Fourth assumption. Fourth assumption is life of the company would be infinite. The going concern assumption that we have in accounting. Going concern assumption says what? Once the company is incorporate, it will have or it will go on and on and on and on and on and on till it is liquidated. ठीक है? मतलब ये सोच के तो कंपनी फॉर्म नहीं करेगी कि आज कंपनी फॉर्म किया कल बंद कर देंगे. Today I have created a company not with the thought that I will just end within 2 years. That is not the thought of any businessman. They assume that my business will go on and on and on till infinite, till perpetual succession. The going concern assumption. Oh, okay, sorry. Fourth is entire capital would be from equity. It means unless otherwise specified, the capital that we have raised for investment, now that is from equity. Only from equity share capital. No debt, no preference. This is fourth assumption. Sorry, I thought you were asking for last assumption. Okay. XYZ Limited has earnings per share of rupees 10. Okay. This is the illustration in the question. Illustration 2. ROI. Capitalization rate means KE. Yeah? Capitalization rate means KE is 10% and return on investment ROI is 12%. Determine the optimum payout ratio and the price of the share at that payout ratio. Okay. So ROI is, sorry, I forgot. ROI was 12% and KE is 10%. KE is 10%. This is the question. Now they have asked the optimum payout ratio. They have asked what? Optimum payout ratio. So let me add something. Let's say, let's take different scenarios. Just for our better clarification, let's take different scenarios. If payout ratio is 0%, let's calculate what is the market price as per Walter. If payout ratio is 25%, let's calculate the market price using Walter model. If payout ratio is 50% and if payout ratio is 100%. Let's calculate the market price of this illustration under different scenarios. Okay? For our better understanding. So tell me friends, all of you have said the formula correctly. As per Walter, price of the share today is nothing but D plus E minus D multiplied by ROI upon KE, the whole upon KE. So our first step is to write down the formula. Now let's take each scenario one by one. Okay? At payout ratio of 0%. At payout ratio of 0%. Can I say my price would be D is 0 now? Because dividend payout ratio is 0%. So entire earnings would be retained with the company. Yes or no? Plus E is 10, D is 0, ROI is 12. 12 means 0.12. KE is 10 means 0.1. The whole divided by 0.1. Tell me friends, what is the price? कितना आया? Please use your calcies. 120. So can I say price of the share today, if dividend payout ratio is 0%, it comes to 120. Market price of the company comes to 120. Bolo, any queries still here? Okay, everyone 120. Likewise, let's solve when payout ratio is 25%. Is 25%. So can I say my D in this case would be 10, into 25% means 2.5. Yes or no? So price, market price is equal to 2.5 plus earnings is 10, D is 2.5, multiply by 0.12, multiply by 0.10, the whole upon 0.10. कितना है आप? Please calculate. Please calculate when payout ratio is 25%. 115. 115. Yes. 115 is correct. D is earning. See, payout ratio is 25%, right? So earnings में से payout होगा ना? Earnings is 10. Of that 25% is dividend. Dividend is what? Distribution of earnings, na? So 10 ka 25%. 2.5. My earnings per share is 10. With this earnings, I can do two things. Whether I can distribute dividend and I retain something with me. So 10 into 25%. Miss Srivani, NL Srivani, NL Shravani. Is that clear now? Okay. Now next, when payout is at 50%, when payout ratio is at 50%, means 50% of earnings is distributed as dividend. So can I say my D in this case would be 10 into 50%, which comes to 5. So P0 is equal to 5 plus 10 minus 5, 0.2, 0.1, the whole upon 0.1. 110. Yes, correct. So P0 in this case comes to 110. Last but not the least, when payout ratio is at 100%, it means entire earnings is distributed as dividend. 10 का 10 पूरा is given as dividend. So can I say P0 is equal to 10 plus 10 minus 10 would be 0 in this case? Yes or no? The whole divided by 0.1. So P0 will be 100. P0 will be 100. Correct. So if you look carefully, the market price, the value of the company was highest when payout ratio was 0. When payout ratio was 0, can you see? At 0%, my market price was 120. When I kept on increasing the payout ratio, the market price kept on falling. See, at 25%, it decreased from 120 to 115. At 50%, it decreased from 115 to 110. And at 100%, it decreased from 110 to 100. Why the market price is maximum at 0%? Because ROI is greater than KE. Read this. Read this. When ROI is greater than KE, optimum payout ratio should be 0%. आ गया उसमें highest market price. Did everyone understand this? Because company has more earning capacity than equity shareholders have. So why to give to them? Yes, 75% by 105. Correct. Correct. The point here to explain was when ROI is greater than K, optimum payout ratio is 0%. Because company has more productivity, company has more earning capacity than the equity owners. Understood? So in this question, in module, they have just asked about the optimum payout ratio. But I wanted to give you better clarity of what I have explained about Walter. Okay? So optimum payout ratio in this question, your answer should be that since ROI is greater than KE, optimum payout ratio should be 0%. And at 0%, you have to calculate market price. Followed everyone? Followed everyone? Yes, you can take 75% also. I have just taken these different scenarios for your explanation. Not just 75, you can take anything. You can take 30%, you can take 40%, you can take 20%, but highest market price under this illustration would always be at 0%. Why? Because ROI is greater than KE. And then it would gradually fall. And then it would gradually fall. At 20%, market price would it would be less than 0%. At 25% payout, market price would be greater than 30%, but it would be less than 20%. Hope it is clear. These four scenarios I just took just for understanding purpose or just to give you clarity. You can take any percent from 0 to 100. The point to explain here is when ROI is greater than KE, market price will be highest at 0% only. Market price will be highest at 0% only. Is everyone following? Bolo, any queries for Walter's model? So the Walter's model ka conclusion is if ROI is greater than KE, optimum payout ratio is 0%. Why? Because if company keeps the funds with itself, it has more productivity. It has more earning capacity. And in contrary, when ROI is less than KE, optimum payout ratio is 100%. So let's take illustration 2. Let's take another illustration. And in this illustration, let's take the other stance where ROI is less than KE. Okay? EPS is same. EPS is 10. Now, ROI is, let's say 10% and KE is 12%. Now, let's calculate market price at three different scenarios. Calculate P0 when payout ratio is three scenarios, 0%, 50% and 100%. And 100%. See, ideally, at this point, you should be very clear that market price in this case would be highest at 100%. Why? Because ROI is greater, is less than K. Yes, yes, ideally should be 100%. So now let's verify that whether it is coming or not. Okay? When dividend is 0%, at 0% payout, P0 will be 0 plus 10 minus 0. ROI is 10. KE is 0.12. The whole divided by 0.12. 10 multiply by 0.1 divided by 0.12. The whole divided by 0.12. कितना आया? What is the price? Manoj has the question. 69.44. Yes, but now we are thinking from maximizing the wealth to the shareholders from long-term perspective. That example earlier which I gave was just from dividend perspective. I am repeating again. It was just from short-term perspective. This is from long-term growth perspective and for maximizing the wealth of the shareholders. And today, in today's time also we can see short-term investors are losing funds, are losing their amount invested, whereas long-term investors like Warren Buffett are creating wealth. So this is from long-term perspective. Hope you are clear. Manoj, hope you are clear. Now at 50%, when payout ratio is 50%. So can I say price would be, dividend would be 5, 10 minus 5, 0.1, 0.12, divide the whole divide by 0.12. And at payout ratio of 100%. P0 price would be 10 plus 0. The whole divide by 0.12. बोलो कितना है at 50%? 50% it is 76.38. And at 100% it comes to 83.33. So can you see my market price is maximum when payout ratio is 100%. Understood? When ROI is less than KE. Wealth of the shareholders is maximum when payout ratio is 100%. Distribute everything. Why? Because they can earn better than the company can earn for them. They can earn better elsewhere than the company can earn. Okay? So Walter's model. With this, we end with Walter's model. We will still solve some practical problems. But conceptual understanding, concept part of Walter is done. Okay? At the end of the session, we will still solve some practical problems given in the module. Next model is Gordon's model. Next model is Gordon's model. Gordon's model. This also you have learned in cost of capital chapter. In cost of capital chapter. Hope you remember this formula. There was, see, as I told you, there are 6 different methods to calculate KE. One was E upon P0. Second was D1 upon P0 plus G. Constant growth model in KE. Yes, growth model. Correct. Growth model. This was the formula. Yes or no? This was the formula that you have learned. So, if I take PO above, can I say it would be KE multiply by P0 is equal to D1 plus G? Yes or no? Now, if I take G on this side, sorry, there is some error from my side. I cannot take KE directly above. Sorry. If I take G on this side, it would be KE minus G is equal to D1 upon P0. Yes or no? G has to be taken on this side. Correct? Now I can take P0 above. Now if I take P0 above, my formula would look something like this. KE minus G, the whole multiply by P0 is equal to D1. Yes or no? So, in other terms, or in other way, my P0 is nothing but D1 upon KE minus G. Are you getting this? This is how Gordon's model has given the formula for price of the share today. This is how Gordon has given the formula of price of the share today. And this entire formula is based on the concept of valuation. ये formula बनी कहाँ से है? From where this formula is derived? It is derived from the concept of valuation. Valuation chapter, you have very detailed at CA final level. Very detailed. There are n number of valuation models. However, we will understand the relevant portion of valuation model in this chapter if time permits. Okay? We will understand some quick basic insights how valuation of security is done. How valuation of any security, be it debt, be it bonds, be it preference shares, how it is valued. We will have some quick insights if time permits in this session. Okay? But did you understand the formula of Gordon? Price of the share today is nothing but D1 upon KE minus G. Okay? What is D1? D1 is nothing but expected dividend. D1 is nothing but expected dividend. Expected dividend in year one or in the coming year. KE is nothing but cost of equity that we already know. And G is nothing but growth rate. G is nothing but the growth rate. Understood? How did you calculate the growth rate in cost of capital chapter? You would have learned one formula. The formula was ROI multiply by retention ratio. Hope you recollect this formula. This you have learned in the chapter of cost of capital. How was growth rate being calculated? It was nothing but ROI into retention ratio. If you are not able to recollect, you need to revise that chapter again. Correct? So growth rate is nothing but ROI into retention ratio. And D1, how did we calculate D1? That is the expected dividend in the coming year. How did we calculate that? It was nothing but applying the growth rate to last dividend paid. It was nothing but D0 plus G. D0 means last dividend, the latest dividend that company has paid, and applying growth rate to it. That is D1, expected dividend in coming years. So if, for example, company has paid dividend of rupees 10 last year and growth rate of the company is, say, for example, 5%. So expected dividend would be 10 plus 5%, 10.5. So expected dividend in the coming year would be 10.5. Hope this is clear to you all. Understood? Everyone? Understood, everyone? So Gordon as well has similar conclusion like what Walter did. Gordon as well has similar conclusion like what Walter did. When ROI is greater than K, when ROI is greater than K, can I say there would be much faster growth? Yes or no? There would be much faster growth in the company when return on investment is greater than cost of equity. Can I say growth of the company would be faster because of the efficiency of utilization of reserves? So faster growth, higher the growth, higher would be the market price of the company. This is inference of Gordon's model. See, again, you have to just remember the formula, apply the figures of each variable from the question and calculate the market price. But the inference of Gordon model is also very much similar to Walter. That's why they both are under relevance side. That's why they both are under relevance theory section. Yes, correct. Correct, Pallavi. Correct. This we are learning from long-term perspective. Like what could be the, how can we maximize the wealth of the shareholders? So by retaining everything, we can maximize the wealth of the shareholders. In that case. Okay? Again, just like Walter, we also have certain assumptions for Gordon. We also have certain assumption for Gordon. Assumption number one. Assumption number one. KE remains constant. KE remains constant. Growth remains constant. Growth rate remains constant. Third is perpetual succession. Perpetual succession assumption means the going concern assumption. Life of the company is infinite. Life is infinite. Company will carry on the business jab tak hai jaan. Fourth, unless otherwise specified, entire capital is raised from equity only. Entire capital raised from equity source only. Nothing from debt, nothing from preference. Last but not the least, this is very important. KE should always be greater than G. KE should always be greater than G. Yeah. Last but not the least, KE should always be greater than G. See, look, there is some error happening here. Wait, let me close this and open again. Let me open this again. I was not able to write in the new slide. Okay, it was stuck here. Assumption 1 was KE remains constant. Second, growth rate remains constant. Yes, correct. Third is perpetual succession, means going concern assumption. Fourth is entire capital from equity source. From equity source. Last but not the least, this is very, very important. KE should always be greater than G. If K is not greater than G, then see how it looks. The formula is something like this. If K is less than G, it means the denominator would be negative. Let's say if K is less than G, this is 0.12 and this is 0.18. So when I say denominator would be negative, so ultimately price would be negative. And what does price negative means? Means you are selling the shares and you are paying money. This is what it means. Negative price means. Are you getting this? If K is less than G, if K is less than G, then denominator will be negative. Denominator negative, then market price in negative. Market price negative means what? You are selling the shares and you are paying, not getting money. You are paying the money. So that's why K should always be greater than G. Hope everyone understood these assumptions. Okay? And as I said, the inference of Gordon is similar to that of Walter. The inference of Gordon is similar to that of Walter only. So since now we have completed these two models, this relevance side theory, let's solve practical problems on these two models. On these two models. Let's try to solve practical problems on these two models. The following illustration number 3. The following figures are collected from the annual report of XYZ Limited. Net profit is 30 lakhs. Preference shares, 12% preference shares is 100 lakhs. Number of equity shares is 3 lakhs. ROI is 20%. KE is 16%. Okay? Compute the approximate dividend payout ratio so as to keep the share price at 42 by using Walter's model. First of all, looking at the question, they have specifically mentioned Walter's model. Whenever you read this word Walter, you need to quickly recollect the formula that is given by Walter. Bolo, what is the formula given by the Walter? First step, quickly recollect the formula that is given by Walter. As per Walter, the formula of the price today is nothing but D plus E minus D multiplied by ROI KE the whole divided by K. Okay? Now read the question again. What they have asked? They have asked to compute the approximate dividend payout ratio. In other words, can I say they have asked here to compute D, whereas they have given this value, price to be kept at 42. Yes, formula is correct. Yes. In illustration 3 that we are discussing right now, please read carefully. They have asked to calculate the dividend payout ratio, means the amount of D that they have asked. And the price, the P0, they have already given in the question. So no worries, we have all the other variables. We have all the other variables. We can calculate. Let's first calculate P0 is given. It is rupees 42. ROI is also given in the question. ROI is 20%. K is 16%. K is 16%. Yes, just put the formula and get the answer. We need to calculate E because E is not given. But to calculate EPS, we have other details that is given in the question. We can easily calculate earnings per share. Can I say my net profit? My net profit is rupees 30 lakhs. If I subtract preference dividend from this net profit, I will get earnings for equity shareholders. And if I divide this earnings for equity shareholders with number of equity shares, I can easily get EPS, which is E. So preference dividend would be 100 lakhs pay 12%. 100 lakhs is preference share capital and 12% is the dividend rate. So can I say 12 lakhs? So my earnings for equity shareholders would be 18 lakhs. Number of equity shares is 3 lakhs. So can I say my EPS comes to rupees 6? Not 6 lakh, it is 6. Not 6 lakh, it is just rupees 6. ऐसी गलती मत करना एग्जाम में. So just substituting all the values in this formula, we can easily calculate dividend. D, earnings is 6. We don't know the value of dividend. ROI is 0.2. KE is 0.16. The whole divided by 0.16. Can you help me in calculating D using the concept of simultaneous equation? Please help me in calculating the value of T. You all are mathematics ke experts. Using simultaneous equation concept. Using equation concept, please help in calculating D. I'm presuming all are solving. Huh? Now, yeah, D. How much is the value of D? Instead of D, you want to take X, then you can take X as well. 3.12. So my dividend comes to 3.12. Okay, Sagar has also got 3.12. Deepali also 3.12. Srini also 3.12. So this is the correct answer. So this is my dividend in rupees. If I want to calculate payout ratio in percentage, so my dividend payout ratio in percentage would be dividend per share upon earnings per share into 100. 3.12 divided by 6 into 100. So my payout ratio comes to कितना आ रहा है 52%. 52% payout ratio. Understood everyone? How to solve using Walter's model? Acha, in this question, we have just asked dividend payout ratio. Now my question to you all, we have learned Walter's model. Tell me, is this the optimum dividend payout ratio? Is this 52% the optimum dividend payout ratio as per Walter? Yes, no. Why no? Because ROI is greater than KE. So when ROI is greater than KE, optimum should be 0%. Hope you all understand. Yes, correct. So can you calculate price when dividend payout ratio is 0%? Can you calculate market price when dividend payout is 0%? Please solve. Yes, Pallavi, correct. This is additional task from my side. Calculate market price now when dividend payout is 0%. Because 52% cannot be the optimum payout ratio. As per Walter. Huh? Please all calculate at the optimum payout ratio. Rachna got 46.875. It should come greater than 42. Huh? Your answer should be greater than 42. Then you have done correct. Okay, 46.875. So when payout ratio is 0%, can you see market price would increase from 42 to 46.875. And if market price increases, it means wealth of the shareholder has increased. Understood how Walter model is working? So illustration 3 is done. Now let's take illustration 4 and calculate. See, as I said, you Gordon also follows or also a similar inference to Walter. Also a similar inference to Walter. So this is the following is the conclusion of Gordon's model. It is just similar to Walter. Okay, now let's solve illustration number 4. The following figures are collected from the annual report of XYZ Limited. Again, net profit 30. Again, inference is same. Again, the illustration, all the figures and all the data given is same. Calculate price per share using Gordon's model when dividend payout is 25, 50 and 100. Illustration 4. They have asked to calculate P0 at 3 different scenarios. Correct? At 25%, at 50%, and at 100%. But I would want you all to add at 0% as well, so that everything gets crystal clear. This is additional from my side. In question, we have to just solve for 3 payout ratios. But from my side, let's solve at 0% as well. Okay? Calculate price. So first of all, first task, whenever Gordon models is asked in the question and whenever they are asked to calculate market price, you have to recollect the formula given by Gordon. P0 is nothing but expected dividend or the dividend per share divided by KE minus G. ठीक है, ठीक है. So let's first solve at 25% payout ratio. We need three variables. We need three variables. D1, we need dividend. Dividend we can calculate easily when dividend can be calculated by applying the payout ratio to earnings per share. Yes or no? If we apply payout ratio to earnings per share, we can get dividend amount. We have KE ka figure, but we don't have growth ka value. Growth rate we don't have directly in this question. But using the formula of growth, the formula is ROI into retention ratio. Yes or no? We can calculate the growth rate using the formula of growth. We can calculate the growth rate. So can I say 25% payout ratio means 75% retention? Yes or no? Another inference I could make is this only, na? 25% is paid as dividend, then 75% is retained. Are you getting this? So at 25% of payout ratio, my growth rate would be ROI is 20% and retention is 75.75. How much is my growth rate? 20 into 0.75. Can I say 15% is my growth rate? Correct? Correct. Now let's calculate D. Let's calculate D. D1. D1 is nothing but earnings per share multiplied by payout ratio. Yes or no? So let's calculate earnings per share through working note. Calculation of earnings per share. Net profit is given. I guess it would be 6 only because all the details are same as last question. Why 70? यार तो फिर then take this 0.2 and take this 75%. बस आपको ऐसे लेना है तो ऐसे कर 20 into 75%. It is one and the same thing. How can you do 20% into 75%? At least one of the variable you have to take it in point, na? Or in whole numbers you have to take. The answer would be same. 0.2 into 75. So it comes to how much? 0.15, that is 15%. Yes, earnings per share is 6. Net profit is 30 lakhs less preference dividend 12 lakh. And how did 12 lakh come? It is 100 lakh of preference share capital multiplied by preference dividend rate. This is my earnings for equity shareholders, which comes to 18 lakh divided by number of equity shares divided by 3 lakh. So my EPS, earnings per share, comes to 6. So can I say my dividend, expected dividend would be 6 into 25%, because we are calculating price when the payout ratio is 25%. So 6 into 0.25 or 25%. And as it comes to 1.5, now I can simply substitute all the variables in the formula. So price is equal to 1.5. KE is how much? KE given in the question is 16%, means 0.16, and growth is 15%. Tell me, how much is the price? How much is the price? 150, correct. So price of the share today, market price of the share today, when dividend payout ratio is 25%, it comes to 150. Okay? Now let's move to second scenario when payout ratio is how much? 50%. When payout ratio is 50%. So in other words, can I say retention is 50% as well? If 50% is paid, then 50% would be retained. So can I say growth in this case would be 20 into 0.5. कितना आया 10%. Correct? KE is given in the question. It is at 0.16. It is at 0.16. And now here D1 would change. D1 would be EPS into payout ratio. Now the payout ratio has changed from 25 to 50%. So D1 would change. So 6 into 50%, which comes to 3. So when I say price, when payout ratio is 50%, will be 3 upon 0.16 minus 0.10. कितना आया 0.16 minus 0.10. 50 rupees. 50 rupees. Last, not last, but second last. Scenario 3. Payout is 100%. Payout ratio is 100%. So in other words, if I pay everything, then I would have retained nothing. Retention ratio is equal to 0. Yes or no? If retention is 0, so can I say my growth would also be 0? Because growth is directly dependent on what you retain. Yes or no? If you retain something, you will reinvest. You will reinvest. You will grow. This is how retention ratio is directly related. Yes, correct. Correct. Srini is correct, but let's first calculate at all the payout ratios and then confirm so that everyone understands. Okay, so in this case, my D1 would be earning is 6 and payout ratio is 100%. So 6. So can I say P0 is nothing but 6 divided by 0.16 and there is no growth. Itna aaya 37.5. Correct? And the additional scenario that I have given from my side, when payout ratio is 0%, when payout ratio is 0%, can I say retention would be 100%? Yes or no? And if payout ratio is 0%, can I say my D1 would be 0 in this case? Because entire earnings of 6 is being retained by the company. Dividend is 0. So can I say my price, if numerator is 0, price would be 0. What cannot calculate? It would be 0. It would be 0, na? Numerator is 0. I hope everyone is understanding. The price of the share would be 0. D1, not it. Your answer should not be, it cannot be calculated. Your answer should be, price would be, market price would be 0. Means illogical. Calculation तो होगा, but it is illogical that price is trading at 0. Understood? So can you see when ROI in our illustration was greater than KE? In our current illustration, ROI was 20% and KE was 16%. Maximum market price was when payout ratio was minimum, was when payout ratio was lowest. Understood? This is the inference to be made. Understood? Was when the payout ratio was at minimum level. So whenever ROI is greater than KE, you should distribute very less to the equity shareholders and retain as much as possible. Okay? So let's move to illustration. Illustration number 9. Let's solve problem of illustration number 9. The following information pertains to Messrs XY Limited. Pertains to Messrs XY Limited. Earnings is 5 lakh. Dividend payout ratio is 60%. So can I say retention ratio would be 40%? Yes or no? Retention dividend payout is for 60, then retention would be 40. Number of shares outstanding is 1 lakh. So earnings of the company is 5 lakh divided by number of shares outstanding 1 lakh. So EPS, earnings per share, is 5. Equity capitalization rate. Equity capitalization rate means KE. KE is 12% and ROI is 15%. And ROI is 15%. Calculate the market value per share as per Walters model. क्या पूछा है? Illustration 9 में calculate market price per share as per Walters model. P0 is how much as per Walters. So let's calculate. First of all, you have to write down the formula, even in your exams as well. First task is to write down the formula. P0 is equal to D plus E minus D, ROI upon KE, the whole upon KE. Okay? Now let's try to find each and every variable. Can I say earnings per share, which is nothing but E, is rupees 5? कैसे आया? 5 lakh is my total earnings for all the equity shareholders and my number of equity shares are 1 lakh. ठीक है? D would be earnings multiplied by payout ratio. Yes or no? So can I say payout ratio is 40%? Sorry, 60%, not 40%. So when I say 5 ka 60%, D is 3. Yes or no? ROI is given. ROI is how much? ROI is 15 and K is 12. And K is 12. So all the variables of the formula we have. We just need to substitute the values. D is 3 plus E is 5 minus 3.15 divided by 0.12, the whole divided by 0.12. Bolo, what is the price as per Walter? 45.83. It comes to 45.833. Any confusion? Any query in the first part of the question? Any doubts? Any doubts? Okay. Let's move to the second part. Please read carefully what they have asked. Second part, calculate optimum dividend payout ratio according to Walters model. What should be the optimum payout ratio according to you all? This is the details given in the question. Give me your opinion. What should be the optimum payout ratio as per Walter model? 0%. Yes. Everyone 0. Correct. So second part, you have to write. Since ROI is greater than KE, optimum payout ratio as per Walter should be 0%, should be 0. Correct? And now they have asked, calculate market price at that optimum ratio. So now second part, they have asked, calculate P0 when dividend payout ratio is 0. Okay, let's calculate that. P0 is equal to 0 plus earnings is 5. Dividend payout is 0. ROI is, I guess, 0.15. 0.12, the whole divided by 0.12. कितना आया? 52.08. Yes. So see, can you see market price has now increased from 45.83 to 52.08. Any queries in question number 9? Any doubts? So as and when we are solving more and more questions, your concepts are getting more and more clear. And practice is the only solution in all the practical subjects. More and more you practice, more and more you solve by yourself, concepts would get clear. Okay? Now let's take illustration number 10. Let's take illustration number 10. Taking an example of three different firms. One firm is under the growth stage, one is at normal stage, and one is at declining stage of life cycle. Calculate the share price using Gordon's model. Whenever they ask share price using Gordon's model, first say you have to recollect the formula. Formula is D1 upon KE minus G. Okay? So I guess all the variables are directly or indirectly given. Let's solve. For the firm which is in the growth stage. Okay, let's solve for company growth. Let's assume these are three different companies. Let's calculate for company growth. So as per Gordon, share price of the company is nothing but D1 upon KE minus G. Now just focus for the company growth. KE is given in the question. KE is 10%. Yes or no? Then they have not given dividend, but they have given earnings and dividend payout ratio. So we can easily calculate dividend. Expected dividend, it is nothing but E multiplied by payout ratio. So earnings is given in the question. It is how much? 10. And payout ratio, dividend payout ratio is 0.4. And as it comes to rupees 4. So D1 is done. K is done. Now our task is to calculate G. G is nothing but ROI multiplied by retention ratio. ROI is how much? ROI is 15% and retention ratio. Can you see retained earnings? This 0.6, this is nothing but retention ratio. If dividend paid is 0.4, then 0.6 would be retention ratio. 15 into 0.6. Yes or no? 9%. Everyone unmute. Can you just type?
Sir, sir, a clarification.
Yeah.
Sir, in question for illustration for when we have taken dividend as 0, P0 came as 0. But in illustration
Yes,
9,
because that is, I understood that is illogical. You have to take at 1% so that you can get at least some value.
No, sir. My query is in illustration for when dividend is 0, we got market price as 0. In illustration 9, when we have taken dividend as 0, P0 was coming, some figure was coming. Can you differentiate it, sir? Can you explain the reason for it?
Sorry, in which illustration?
4 and 9, sir. 4 and 9. In 4, P market price was came 0, sir. 4, sir. Illustration 4.
See, 9 is about Walter and 4 was about Gordon's formula.
So because of formula, it was came. Because of that model, it was came like that, sir.
Yes, because of the formula. So you can calculate. See, Gordon says when ROI is greater than KE, Lower the payout ratio, higher would be the market price. This is the inference of God. Are you understanding? Similar inference is for Walter also. When ROI is greater than KE, lower the payout ratio, higher would be the market price.
But that much difference will come, sir, because of different models. Here zero, here figures were coming.
Sorry, here zero what?
In
Yes, so
illustration,
Walter, so in that case, when payout ratio is 0% now, so your Gordon's model will based on earnings.
okay,
Based on earnings.
okay.
Okay?
But that much difference will come, sir, because of
Yes, that much difference will come under both the models. Yes.
Sir, small request.
Uh,
In fourth, can you do it with Walter's model, and nine, can you do with the fourth model, and how much result will come? Can you explain, sir, like that?
you can also try it at your home first, and when the next session is done, you can commit with your answer. Because I want to continue further as well. So you can try it as per the formula that I have taught you. You can try it at your home. So there would be some confusion again coming to you. So in the next session or in the revision session, we can clarify this. Okay? First,
Because that
I would
much,
want you to try by yourself.
because that much difference was came. So if your difference is small, then I would not have asked, because of lot of difference. I'm asking.
Sorry.
If there is a minute difference, I would not have asked, sir, because there is a lot of difference between both models. I'm asking, sir.
How much difference is coming according to you?
There is zero is coming, here 52 is coming, sir. That's what I'm telling.
Yeah. So because Gordon's model is based on, as I said, we have taken dividend. In that case, you take earnings per share. In that case, you
Oh,
take earnings per share.
okay, sir.
Okay? When dividend is not there, you take earnings per share. Assumption is different, yes, for both the assumption, for both the models. Why? Because under Walter, the dividend is constant every year. But under Gordon, dividend is not constant because growth is there every year. Growth rate is constant, but dividend amount would change. Are you getting this? So this is the primary or the key difference between two models. Walter says dividend is constant till life. Walter says dividend is constant till infinity, whereas Gordon does not say that dividend is constant. It says growth rate is constant on dividend, but dividend every year will change. Both the models are not inverse. Both the models are parallelly running with each other.
But I'm having that confusion, sir.
Can you just mention some figures so that I get clarity?
Just I'm asking, in fourth question you apply this Walter's model, and in ninth question you apply this fourth model, sir. That only I'm telling that, sir. Model reverse I'm telling. Just reverse the model I'm telling.
Okay, first let's solve this question and do that.
Okay, okay.
Okay.
Hello, sir.
Where was I? Yes.
Sir, in Walters, I think it's ROE is greater than growth. So, but in that Gordon's model, it is not there. So that is the difference, I think.
No. ROI is greater than KE also involved. In Gordon's also we saw that ROI is greater than KE. In illustration 9 or 4, I don't remember that. It was same inference. When ROI is greater than KE, first let's solve this and let's come back to that question. Okay? Let's solve this because link will get broken. Now where was I? Which illustration we were solving? Illustration 10, right? Yeah, so when we are solving for company growth, can I say I have all the variables now? I have D1, I have KE, I have G. Okay? So my price would be D1 upon KE minus G. D1 is 4, KE is 0.1, G is 0.09. How much is the price for the growth company? It is 400. Okay. Now let's solve for company normal. In that case, my growth would be, ROI. ROI is 10% and retention ratio is 0.6. 10 into 0.6, which will be 6%. Correct. And dividend in this case would be earnings is how much? Earnings is 10 and payout is 4. 40%. So earnings is 4. Sorry, dividend is 4. So P0 in this case would be 4 upon KE. KE is 0.10, G is 0.06, not 0.6. Huh? So it comes to how much? 40 divided by 0.4. 40 divided by 0.04. Sorry. 0.1 minus 0.06. 0.04. 4 divided by 0.04. 100. Not 40, but 4. 100. And third, for declining company. G is equal to 8 into 0.6. 8 into 0.6. 4.8. Yes or no? Dividend will remain same because earnings per share is 10 and payout ratio is 6. So my P0 in that case would be 4 upon R is 0.08 minus 0.048. 4.8 is written as 0.048. 76 76.92. ठीक है. So this was illustration 10 only. This was illustration 10 only. This current illustration is 10 only. You, Hardik, this illustration is 10 only. We are solving illustration 10 only. Hardik, please right now just forget about investment decision. We are solving dividend decision. So focus on that. Please don't distract the class. Because everyone understood this illustration number 10. Illustration number 10. Any queries? Okay. Now, student had a question. You want me to solve illustration number 9 by which model? Tell me. You want me to solve illustration number 9. Number 9 was Walter 9. Now you want me to solve by Gordon's model. Correct? This is what you all want me. I forget the name. Okay, Sai. You told na solve illustration 9 by Gordon and 4 by Walter. Something like this you said na, just inverse the position. Sai Kiran, please respond. You told me to solve illustration 9 by Gordon, correct? I'm waiting for. Yes, so let's do that. Earnings, payout, number of shares, KE, ROI. ठीक है? So I'm reversing now. Question illustration 9 was Walter. I'm solving by Gordon. P0 is equal to D1 upon KE minus G. ठीक है? Dividend. Expected dividend is nothing but earnings into payout ratio. Earnings is rupees 5. Earnings per share was rupees 5 and payout ratio is 60%, which is 0.6. So dividend comes to 3. Correct? KE is given in the question. KE is 12. G is not given, but we have ROI and retention ratio. So we can easily solve G. ROI is 15 and retention ratio would be 40%. Yes or no? Since dividend payout is 60%, retention ratio would be 40%. So my G comes to 15 ka 40%. Comes to 6. Correct? So my P0 comes to 3 divided by 0.12 minus 0.06. It comes to how much? 50 per share. Okay. Now what is the confusion here? I didn't get. What you want? Answer would be difference between two models because the assumptions are different. Here Gordon model considers growth. It means dividend would grow every year but at a constant rate. But Walter has assumed that D remains constant. Understood? When to add growth? When the company or when the question has a line like this, like that the last dividend paid by the company is rupees 4. So the last dividend or the recent dividend paid by the company is rupees 5. This is the hint that you have to add growth to the last dividend. I don't have unmute right. Tech team, can you unmute Sai Kiran? Now, if you want to solve at payout ratio of 10% using Gordon, you can try and solve that. The same illustration, you can take payout ratio as 10% and you can solve that. Market price would be higher. First of all, illustration 9 is clear to you. I don't want to come back again to this illustration. I will come to question 4. But first, question 9 is clear to you. Because I cannot come back again and again to the same illustration. So tell me, illustration 9 clear? Then I will move to question 4. Okay. Now let's go to question 4. Okay, now let's solve. Do it for all the scenarios using Walton model. Tell me under which scenario I should solve question 4 using Walter. Tell me. Do you want me to solve all the scenarios like at 25%, 50 and 100 also? Only for 0%. Okay. Illustration 4 using Walter. At 0% payout ratio. Yeah, whenever I ask to all the students that is this illustration clear? Is everything clear? Do you have any queries? At that time, you don't respond. When I switch to another question, then you tell me to again go back to previous illustration. So please don't do like this. It is little frustrating to the professor. Whenever we are in that illustration, I give you some time to ask me some queries. So at that time, you don't ask. But now you are asking. But henceforth, don't do this. I will explain you, Niru. I will come back to illustration 10 again. But please, from next time, take care of this. Whenever we are solving that illustration, ask at that point in time. Once we switch the illustration, don't ask. I give you enough time. Because the link gets broken. I don't mind asking queries, but the link gets broken afterwards. So I was in illustration 4 and Sai Kishan wanted me to solve using Walter's model at zero payout ratio. Okay? So first of all, write the formula. Dividend is zero. Earnings per share is how much? Earnings per share, I guess it was rupees 6 in illustration 4. ROI is 0.2 divided by 0.16. The whole divided by 0.16. कितना आया? P0. कितना आया P0? $28.125. 28.125. ठीक है? Sai Kishan, now it is clear to you. Now it is clear. $46.87 to 28.125. Let me calculate. 6 into 0.2 divided by 0.16. The whole divided by 0.16. 46.875. So it comes to 46.875. ठीक है? So when ROI is greater than KE, it is highest at 0%. At 25%, at 50%, at 100%, market price will be lower. Can we move ahead now? See, it is infinite. At Gordon's model, it is unable to calculate. When dividend payout ratio is zero now, can I say retention would be 100%? Retention ratio is 100%. Yes or no? When dividend payout is zero, retention ratio is 100%. So can I say my G would be return ROI multiplied by retention ratio. Now see what is my ROI. It is 20% multiplied by, sorry, 20% multiplied by 1, entire 1, because everything is retained. So when I say my G is 20%, yes or no? And my KE is how much? My KE is how much? 16%. So can I say here KE is less than G? So we will not be able to solve. Hope you remember the assumption of Gordon. KE has to be greater than G. Only then we can solve. Hey, are you following? Are you following? Assumption of Gordon is that KE has to be greater than G. But when dividend payout is 0%, KE is less than G. So we cannot solve at 0%. Gordon's assumption will get striked off. Hope now it is clear. It is striking of the Gordon's assumption. Okay. So now let's move to third model, Graham and Dodd. I know we have to learn theory, but it will take a considerable amount of time. And since we have just half an hour, we will cover other topics other than Okay? In the next session of dividend decision, we will learn in detail. And because other models are very small. So, two sizes, and Dodd. So again, as I said, all the finance scholars have given formula. Graham and Dodd also has given formula. As per Graham and Dodd, price of the share today is nothing but multiplier multiply by D plus E upon 3. This is the formula given by Graham and Dodd. Just like Walter has given formula to calculate share price, just like Gordon has given formula to calculate share price, likewise, Graham has also given his own formula based on his own research, based on his own analysis to calculate share price. I am coming to that. I was about to E के divide में 3 लिखा है 3 number 3. I am coming to derivation point. As I said earlier that to calculate market value of the company or to calculate market price of the company, there are n number of valuation models available. There are n number of valuation techniques available. And all such techniques, you have detailed version at CA final level. Okay? You have detailed version at CA final level. N number of techniques. N number of techniques, I would say that you can create your own valuation technique as well. You just need to justify the opposite person sitting with you. If you are able to create your own valuation technique and the opposite person gets satisfied with your technique, then that is the valuation model. Are you getting this? The valuation techniques are very much practical. One such technique of valuing the market price or calculating the market value is P multiple model. P multiple model. What is P multiple model? Can I say market price per share is nothing but EPS multiply by P multiple? Yes or no? This is one of the technique to value market price or to calculate market value of the company. Correct? So under Graham and Dodd model, what he did, he took EPS as E. EPS is denoted by E. And just like P multiple, he multiplied with some multiplier, which is called M. It has relevance to P multiple. M is nothing but a multiple. Just like we have P multiple under P model, M is a multiple. M is a multiplier. Okay? Again, if I write this way, E plus D minus D multiplied by M, will my answer change? Tell me, will my answer change? M is multiplier, we have just like P multiples. Answer will not change. Okay. If I write this way now, D plus E minus D, will my answer change? Tell me. Again, it will not change. बस D को आगे ले लिया. I took it ahead. Correct? Now see, D. I am separating this E minus D. I am separating this E minus D. I am separating from dividend. Again, still the answer remains same. If you can make out, this E minus D is nothing but retained earnings. And this D is nothing but dividend. Correct? Still the answer remains same. Any query still here? Any query still here? E minus D, earnings में से if I deduct dividends, can I say the balance would be retained earnings? Now see what Graham and Dodd said. He practically undertook survey of different investors. He undertook survey. He asked some questions to different equity shareholders. What question he asked? He asked one simple question to different equity owners. Now pay attention to what he asked. He asked, if the company pays you dividend today, are you interested in that? Or if the company keeps the retained earnings with itself, then it will reinvest the retained earnings, then it will do some growth from that retained earnings, then again reinvestment, then again growth, again reinvestment, and again growth. And after few years, company pays dividend from that retained earnings. Are you interested in that? He asked two questions to equity shareholders. What he asked, are you interested if company pays the dividend today, or are you interested in company paying the dividend after certain years? Once the retained earnings are reinvested, growth is happening, again reinvested, growth, again reinvest, growth, again reinvest, growth, and then after certain point in time, company paying you dividend. Are you interested in that? Bolo. If I ask you the same questions, no clear. Okay. Again I am explaining. Graham and Dodd asked simple two questions to equity shareholders. One question is, if the company pays dividend today, if the company pays dividend to you all today, are you interested in that? Are you interested in accepting that dividend today? Means, are you interested in taking the cash today from the company? Or are you interested in getting dividends once in a while in future? Why once in a while? Because can I say retained earnings? E minus D is nothing but retained earnings, correct? It would be invested in the project. From that investment, company would earn something. Then again, company will retain something. Again, investment. Again, from that investment, company will earn something. Again, retained earnings. Again, investment. And after few years, company is paying dividend once in a while. So are you interested in that? Bolo, I ask you this question. Which one you will choose? Which one you will choose? पैसा आज मिल रहा है, लक्ष्मी जी आज आ रहे हैं, उसमें इंटरेस्ट? आर यू इंटरेस्टेड इन गेटिंग द कैश फ्लोज टुडे और once in a while in future? See, as a layman, what layman will think, they would want dividend to be paid today. Why? Future is very, very uncertain. What if the company does not pay dividend in future? What if the company falls drastically down? Are you getting this? Future is very uncertain. You don't know what will happen in the future. So most of the businessmen or most of the investors who has a mindset of businessmen, they would want company to pay. They would want to have cash today. Are you understanding? Are you getting this? So what Graham and Dodd did, see, of the 5 investors, he undertook interviews, he asked this question to different investors. Of every 5 investors, 4 were interested in dividend today. 4 were interested in getting the dividend today because cash flow is getting generated today. Future किसने देखा है? Future is very uncertain. No one has seen the future. So they were all interested. If company is giving the dividend, take it, take it, take it. And one investor was of the opinion of retained earnings, that it is okay to get dividend once in a while. See, are you understanding the question here? Yes, take dividend. That's what I'm saying. The future is uncertain. Let's say war happens in India. Can I say company band ho jayegi? You will not get any dividends in future. If company is giving dividend today, take it now. Why you are saying I want it in future? So of every five investor, four were of the same opinion to take the dividend today, to take the cash today. Future is uncertain. No one has seen the future. So what he did, Graham and Dodd gave 4 times weightage, more weightage, gave 4 times more weightage to dividend than retained earnings. Are you getting this? Practically, as per his review, as per his survey, he found that dividend should have more weightage than retained earnings because investors are more interested in getting paid dividend today. Are you getting this? So he gave 4 times more weightage to dividend. Clear till here now? Still the formula, we have not reached to the formula yet. But clear the logic behind the derivation. So it means, can I say P0 is nothing but 4D plus 1E minus 1D. 1E minus 1D multiply by multiplier. Correct? 4D minus 1D. Can I say 3D plus E multiply by multiplier? Correct? Any query still here? Now divide, if I divide this by 3, can I say 3D divided by 3 plus E, the whole divided by 3. You can write this way also. 3D divided by 3 plus E divided by 3. Multiply by multiplier. 3 gets cancelled. The formula is D upon E3 multiply by multiplier. This is how I feel he would have derived his formula. He would have devised this formula. Are you getting this? Are you understanding? This is how I feel. This is how the derivation of this formula would have happened. The ultimate logic of Graham and Dodd is that more weightage should be given to dividend than retained earnings. Why? Because investors are more interested in getting the dividends today rather than retained earnings, rather than getting paid once in a while. Both the sides means which both the sides? I'm just dividing this 3 by this part. By this part. Okay, understood the formula of Graham and Dodd. So the logic is more weightage is to be given to the dividends more weightage is to be given to the dividends than retained earnings. And he gave 4 times more weightage because it was as per his research. This is what I'm saying now. This is what how he would have devised this formula. Because since here it was 3. To knock it off, he would have divided by 3. Answer would remain same na. Just think from the final answer perspective. Answer, if you take here 5, then it would be 3D divided by 5 plus E by 5 multiply by multiplier. Answer would remain anyways same. Think from that perspective. He would have divided by 3 just to knock it off. But ultimate answer would remain same. You divide it by 5, you divide it by 10, answer would not change. We are concerned with that final answer. Okay? Graham and Dodd, I guess we don't have any practical illustration, but we have one MCQ for Graham and Dodd. Let's see if we have MCQs. No, I guess we don't have MCQs. Hi, we have, sorry. Can you see MCQ 10? Yes, correct, sir. Compute EPS according to Graham and Dodd approach from the given information. Market price is given. See, they have given P0. Dividend payout ratio is 60%. Multiplier is 2. Correct? We just have to calculate earnings per share. Means in this formula, we have to calculate E. We have to calculate E as per Graham and Dodd. Okay, so MCQ 10. So first, had this question asked on subjective part, then our way of solving would be like this. Since it is MCQ, you can directly solve on Cal C. But had this been a subjective question, your way of solving should be like this. First, you have to write down the formula. P0 is equal to D plus E upon 3 multiply by M. Okay? P0 is given. P0 is given 56. D I know. It is 60%. Can I say it would be 60% of earnings? So can I say it is nothing but 0.6 E? Yes or no? Plus E upon 3. Multiply by M is how much? Multiplier is 2. Can you help me in getting the answer of E? कितना आ रहा है? From examination perspective, as far as I have gone through various papers, Walter and Gordon is highly asked. But that does not mean Graham and Dodd and Littner cannot be asked. Most of the questions come from Walter, Gordon, and approach. But please mark my words carefully. It does not mean that any approach cannot come. It is not likewise. ठीक है? ये ध्यान से सुनना. So EPS comes to 30. So 30 and MCQs. A is my correct answer. ठीक है? MCQ A is my correct answer. Follow any questions in Graham and Dodd? Graham and Dodd is this much only. We don't have any. No, beta is the risk component. Beta denotes the risk component. This M multiplier, just we have P multiple. What was P multiple? It denotes the willingness of the investor to pay how much times. That is P multiple. So here also it is willingness to pay how much times. That is multiplier. Let's say if what was P? P is nothing but MPS upon EPS. Correct? What was P? It was MPS upon EPS. Let's say MPS is 20. EPS is 2. Can I say it is 10 times P multiple? It means investor is willing to pay 10 times more. Is willing to pay 10 times to earn rupees 2. This is how you interpret P. P multiple shows the willingness of investor. P multiple means he is willing to pay 10 times to earn 2. So similarly, this is willingness of an investor, and beta as per CAPM denotes the risk of the market, denotes the systematic risk of the company in relevance with market. Okay, so Graham and Dodd was this much. Now we have some theoretical aspects. See, now let's cover some theoretical aspects of this chapter. We still have to learn theory. We'll still have to learn Lintner's model. Okay? We are still left with two models. We will discuss those two models in our next session of dividend decision. We will discuss those models in our next session of dividend decision. But as of now, why? Because right now it is a time constraint. Within 9 minutes, I cannot complete any of this model. So let's cover some theoretical aspects. Let's cover some theoretical aspects. Dividend forms, or I would say forms of dividend distribution. How can a company pay dividend? So there are different forms of dividend payment to the company. In which form company can pay dividend to the company? So ideally, there are three ways of paying dividend. Dividend to the company can be paid in three ways. One is directly pay cash to the company. We call it as cash dividend. Yes or no? We term it as cash dividend. Pay cash every year. Second is bonus shares. Issuing bonus shares. If company does not have enough cash with itself, then company will issue dividend in the form of bonus shares. And technically, it is called as stock dividend. Means company is giving something to the investor, but in the form of shares, not in the form of hard cash, or not in the form of NEFT, or not in the form of RTGS. Okay? So this is another form of dividend. A company can issue, company can issue bonus shares. There are certain criteria to be complied with. Let's say it should be authorized by articles of association. This you would have studied in law, or this you would have studied in accounts as well. That articles of association of the company should authorize these bonus shares. Second, bonus shares should be only paid from the free reserves and not from the capital reserves. So there are certain compliance that needs to be checked. But bonus shares can be issued by any company. And what is bonus shares? Bonus shares are in dividend only now. How it is void? It is just that you need to comply with certain conditions. Condition is that bonus shares to be paid only from the free reserves. It must be authorized by articles of association, and there are certain other conditions as well that you would have learned in law part. And also in accounts part, you have this chapter, na, bonus in accounting. So there are certain conditions. And third is share repurchase. If you have not learned that, I think you need to revise. Third is share repurchase, means buyback of shares. Third is dividend in the form of buyback of shares, means company is paying cash but taking the shares back. So this is one time process. This is one time process. This cash dividend will be every year. Will be every year till the time an investor is a equity shareholder of the company. But this share repurchase is a one-time process. Buyback is a one-time process. Pay the cash, take the shares back. So it is also considered as a part of by issuing bonus shares. Yes, number of equity shares will increase na, in that case. So denominator will increase. So EPS will fall. But the number of shares to the investor will increase. Pallavi, you are correct. Okay? So you can read this theory which is in the start of this chapter. Forms of dividend. Can you see forms of dividend? Cash dividend, share repurchase. Third is stock dividend, bonus shares. So as I said, there are certain conditions to be complied with before issuing bonus shares. Hardik had this question that bonus shares is not allowed, but it is allowed subject to that you comply with certain conditions. What are those conditions? Can you read here? As per SEBI, the bonus shares should be authorized by articles of associations. This is first condition. Second, bonus shares cannot be declared unless all partly paid shares are converted into fully paid shares. So second condition is that you need to convert partly paid shares into fully paid shares. Third, there must not be any default in repayment of loan interest and statutory dues. This is third compliance. You would have not defaulted in payments of these loans, interest, or any dues. Fourth, as I said, bonus to be issued only from free reserves, nothing from capital reserves or asset revaluation. So I think you need to revise your other subjects as well. This is what I could make out. Okay. Other concept is about stock split. These are just theoretical part of this chapter that is there in your module, and I'm just trying to cover that. Because if we start any of the approach today, we will not end. I think you need to get clarity from your law professor. As far as financial management is concerned, bonus shares are issued by the company. In reality as well, they are issued by the company. So if you want more clarity, you can ask your law professor. Okay? Next is stock split. What do you mean by stock split? What do you mean by stock split? It means splitting. See, here it is written. Let's say if there is one share of 1,000 each, one share of 1,000, then we are splitting this share in more numbers. Means now 10 shares of 100 each. This is called a stock split. Stock split. Earlier it was one share of 1,000 each. But now 10 share of 100 each. I am splitting it into more number of shares. I am splitting it into more number of shares of 100 each. Why does company do stock split? One of the major reason is that if we see here, had the price of the share be 1,000, can I say it is less affordable? Can I say it is less affordable to the investor? Yes, liquidity. And can I say from investor perspective, had the price of the share be 1,000, can I say it is less affordable compared to this 100? So if the company does the stock split, more and more investor has the opportunity to buy the shares of the company. Understood? So right now, we cannot purchase the share of MRF because the share price of MRF is very high. So not all investors can afford. But had the MRF company do the stock split process, it is chances that now the investor can invest in that company. Yes, for more participants. Infosys DC, yes, so that more and more investor can participate. More and more investor can participate. The only benefit to the existing shareholder is that their quantity get increased. And over a period, from long-term perspective, they can earn more. But from long-term perspective, not from short-term perspective. From short-term perspective, the only benefit is that number of shares, the quantity gets increased. Okay? But the reason of stock split is that affordability part. More and more investor can participate. If company wants to attract more and more investor, the price should be affordable. Earnings per share would reduce. Correct. You are correct. Your inference is correct. So in today's session, we have completed Walter's model. we have completed Gordon's model, we have completed Graham and Dodd model, we have completed certain theory parts, like what do you mean by stock split, then different forms of dividend. Okay? Any queries, any clarity before we end today's session? Sorry to be little rude or little strict with you today, but the point was just to not break my link. That was the ultimate point. Okay? So if anyone had felt bad from my strictness, I apologize to you all. Thank you all. Have a nice weekend. Thank you all. Have a nice. See, again and again, Hardik is in investment decision. I cannot take investment decision right now. You can come at a revisionary lecture or when the institute conducts doubt solving session. Okay? Thank you everyone. Have a nice day.